Bloomberg Audio Studios. Podcasts, radio, news.
Here's the latest this morning. Fed Chair Jay Powell saying that recent inflation data hasn't materially changed the overall picture when it comes to rate cuts this year. Former New York Fed President Bill Dudley saying he thinks the Fed is wrong about how low rates will go, writing this: betting against the Fed is a fraught endeavor. Nevertheless, in this case, I think the market is right. While the Fed's projections for 2024 look likely to be more accurate than the markets at the start of the year, this time around it's the central bank, not the market, that will probably have to adjust. Bill, I'm pleased to say, is with us now for more. Bill, this came up in our last conversation together, the spread between the market and the Federal Reserve. What do you think explains that? Is that just a refusal, a reluctance of this Fed to really engage in that debate before we get past this inflation hurdle?
Probably the Fed is focused more on, what they're going to do in 2024 and don't have a lot of confidence about what's going to happen beyond that. What I think is interesting is earlier in the year we had a gap between the market thinking the Fed was going to ease quite a bit, 6 rate cuts. Fed only had 3. That's closed. But now the gap has gone the other way. The market thinks that the federal funds rate is going to bottom out around 3.75%. The Fed, in their summary of economic projections, has it going down to 2.6%. So there's over 100 basis points different. I think the market's right that the Fed's not going to go as far as the Fed is projecting in their summary of economic projections for 2 reasons. One, inflation is probably not going to average 2%. It's probably going to average a bit higher than 2%. And number 2, R-star, the so-called neutral rate, that sets a neutral monetary policy, probably has risen, given the large fiscal deficits, the AI investment spending boom, and a host of other factors that are basically putting more pressure on the pool of savings.
Bill, I often reflect on a conversation you and I had together a number of years ago. I'll sing your praises because you're a modest man and won't do it for yourself. You said in June of, I think, 21 that rates are going to go much higher than people think. And I remember when you talked about 5, and 5 sounded so foreign. 5 at that time now would be like me saying that 10-year yields are going to 8%. People just turned around and were like, Bill, you're nuts. We're not going to 5%. What did you see that early that led you to believe that rates would need to be that high to get inflation down? And how does that inform your view of where things will be longer term?
Well, the Federal Reserve set themselves up deliberately to be late in terms of tightening this last cycle. They basically said we can't raise rates until inflation is 2%. We're at full employment, and we expect inflation to be 2% above 2% in the future. So by definition, they were going to be very late. If you're late, that means you have to do more. So that's the reason why I thought that the rates would have to go quite a bit higher than they expected. This time, I think my disagreement with the Fed is the fact that they still think neutral federal funds rates very, very low, 2.6%, their median estimate of the long-run neutral federal funds rate at 2% inflation. And I think that's probably not the case. I mean, it's true after the great financial crisis when we had a lot of financial damage to the economy. But if you look back at the Taylor Rule prior to the great financial crisis, Taylor Rule had 2% real rates as neutral. So the 0.6% reading that the Fed has as their median estimate seems awfully low to me.
Given that, how much do you think that there needs to be a full repricing of just how much of a cutting cycle there needs to be in the very near term? In other words, if 3 rate cuts this year seems a little bit lofty, given how strong the data has been, and you see a more likely chance of 2 or 1?
Well, I think this year is really going to depend, as Powell says repeatedly, on the data. Small differences in the growth rate and the inflation outlook are going to change whether the Fed does a little or more. I don't think 3 rate cuts are out of the realm of possibility. I think where I disagree is more longer term. And you've seen what's happened. The market's repriced that longer term upwards. 3.75% is the bottom for the federal funds rate, and that's what's pushing up 10-year bond yields. So the bond market is adjusting to the fact that they're changing their expectations of where the Fed's going over the longer term.
The reason why I ask this is because every time we hear from Powell, he talks about bumps in the road. And he talks about how recent data, even though it's come in hotter than expected for the most part, doesn't alter his view that it would be appropriate to start cutting rates at some point in the near future. At what point should that shift? Should some of these data points be viewed as something other than bumps?
Well, his view is that monetary policy is tight, and so it's just a question of time before it slows the economy. The other thing he thinks pretty strongly, and he's talked about this yesterday again, is that the reason why growth is strong is because of supply chains normalizing. So you've supply constraints for holding back the economy, supply chains normalizing, you get a one-time increase in the growth rate. I think that what he's underestimating is the fact that financial conditions have eased a lot since late October, and that's also supplying considerable support to the economy.
And it also raises this question, I know you addressed this last time you were on, about whether policy is truly restrictive or not. And you didn't think it was nearly as restrictive as many people had expected. Do you think that there are more people on the Fed who are coming around to this view, who are thinking, wait a second, if we're seeing such easing in financial conditions at rates where they are, maybe that suggests we're not nearly as restrictive as we keep saying?
I think very slowly we're starting to see that happen. The median estimate from the Fed officials about where neutral federal funds rate is at 2% inflation moved from 2.5 to 2.6%. So it moved to 1/10%. So it's starting to move. And the other thing that's important here to note is there's a big skew to Federal Reserve officials' estimates. The bottom is at 2.4, the top is at 3.8. So there's plenty of room for the median to move considerably higher than the 2.6% that they have today. So I think it's going to continue to drift up.
Bill, love this piece. Fantastic. Just out this morning. Bill Dudley of Bloomberg Opinion. Bill, thank you. The title of this piece, the headline, "The Fed is wrong about how low rates will go. Betting against the Fed is a fraught endeavor." But Bill says, in this case, I think the market is right.